Would you like to take advantage of the extreme volatility of 2020, looking for a great deal on a quality stock even after the big run that's occurred in November? Want to collect a market-smashing yield that's more than 4 times higher than the broader market? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is meeting a significant portion of North America's energy needs. Turning on your lights or charging your smartphone requires energy, and this company is making sure that energy gets to where it needs to be. It's the largest energy infrastructure company in North America. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Enbridge Inc., which appear to be trading at a significant discount today. Enbridge Inc., stock ticker ENB, is an energy distribution and transportation company that owns and operates crude and natural gas pipelines across the United States and Canada. It also operates a gas utility business. Additionally, the company has considerable exposure to renewable energy through a diversified portfolio of renewable energy projects. Founded in 1949, Enbridge is now a $59 billion by market cap energy powerhouse that employs 13,000 people. The company has 5 business segments: energy services 58% of fiscal year 2019 revenue, liquids pipelines 20%, gas transmission and midstream 10%, gas distribution 10%, and renewable power distribution 1%. After merging with Spectra Energy Corp in 2017, Enbridge is now the largest energy infrastructure company in North America. The company operates the world's longest and most complex crude oil and liquids transportation system. For perspective, their pipeline network stretches from Norman Wells, Canada to Brownsville, Texas. They operate over 17,000 miles of active crude pipeline across North America, split almost evenly between the United States and Canada. The company transports 25% of the crude oil produced in North America. They also transport about 19% of all natural gas consumed in the United States. Put simply, they are a massive and critical energy infrastructure company. In addition to this energy infrastructure, Enbridge is Canada's largest natural gas utility. They have approximately 3.8 million retail customers in Ontario and Quebec. To cap it all off, they've committed more than $7.8 billion to renewable energy and power transmission projects that are currently in operation or under construction. This area of the business will take on a greater percentage of revenue as projects complete. While the role of hydrocarbons in meeting the world's energy needs is slowly deteriorating, there's no doubt that our society currently cannot function without these products, and there's no immediate future in which that reality is all that different. Furthermore, Enbridge has largely insulated itself from volatile commodity pricing. The company estimates that approximately 98% of its cash flow is predictable through regulated operations, take-or-pay contracts, or fixed fees. This is a big reason why Enbridge has been able to stack up one of the most impressive dividend growth track records in all of energy. They've increased their dividend for 24 consecutive years. Impressively, their overall dividend history goes back 65 years. The 10-year dividend growth rate is 13%. That's a very high growth rate when paired with the stock's current yield of 7.8%. It's just not that very often that you see this kind of combination of both yield and dividend growth. This yield smashes the market. It's more than 4 times higher than what the S&P 500 offers. It's also more than 270 basis points higher than the stock's own 5-year average yield. And with the company guiding for fiscal year 2020, distributable cash flow per share at a midpoint of $4.65 Canadian, the dividend is covered by a payout ratio of 69.7%. Looking at business growth, Enbridge grew its revenue from $15.127 billion Canadian in fiscal year 2010 to $50.069 billion Canadian in fiscal year 2019. That's a compound annual growth rate of 14.22%. Super impressive growth here. Now, much of this was a result of the 2017 merger. Still, there was evidence of secular growth even prior to that event. Meanwhile, the bottom line also shows healthy growth. Now, I won't be looking at earnings per share in this case due to the way Enbridge operates and shows profit. Being an infrastructure business with a large midstream presence, it reports cash flows more in line with how a master limited partnership would. And I'll also be showing distributable cash flow per share growth from fiscal year 2017 onward. This is due to the Spectra acquisition and the move away from prior reporting of cash flows in an ACCFO format. Enbridge produced $3.68 Canadian of distributable cash flow per share in fiscal year 2017, and they're guiding for $4.65 Canadian for fiscal year 2020. That would be a compound annual growth rate of 8.11%. The structure of the business is responsible for the lower bottom line growth. Like an MLP would do, Enbridge funds a lot of their growth through equity and debt. This is not as impressive as top line growth, but you're pairing that with the near 8% yield. It's more than enough. Looking forward, CFRA is anticipating that Enbridge will compound its earnings per share at an annual rate of 7% over the next 3 years. I'm assuming they're using earnings per share growth as a proxy for cash flow growth on a per share basis. Notably, Enbridge management has been repeatedly guiding for 5 to 7% growth in distributable cash flow per share post 2020. Severe disruption is obviously upon us with the pandemic. However, even with the reduction in demand for energy products, Enbridge's business hasn't been affected that much. This circles back to what I mentioned earlier about the fairly insulated business model. For context, Enbridge recently reported fiscal year 2020 Q3 results that showed almost completely flat year-over-year distributable cash flow per share. That's vastly different than what a lot of other companies in the energy space have experienced. And this is why Enbridge is one of the clear leaders in energy as it relates to quality and reliability. This is also why they've built up such an outstanding dividend growth track record. CFRA's growth forecast is at the top end of what Enbridge management has been guiding for, and I personally scale things back in the face of so much uncertainty, but even a mid-single digit growth rate closer to the low end of management's expectations would still be more than enough to propel a fantastic total return and plenty of overall income. Moving over to the balance sheet, the company has a really good financial position. This position has improved in recent years too. The long-term debt to equity ratio is 0.90. Enbridge has lowered its consolidated debt to EBITDA down from approximately 6 times in 2016 to under 5 for this full year. Their credit ratings are in investment grade territory. Standard & Poor's rates their senior unsecured debt at BBB+, Moody's Baa2, and Fitch BBB+. Profitability is somewhat difficult to gauge because of the way the company reports profitability. GAAP numbers can be irrelevant in some cases. Over the last 5 years, the firm has nonetheless averaged annual net margin of 5.56% and annual return on equity of 6.79%. Energy has been one of the worst performing areas of the whole market over the last year. Enbridge's stock has got caught up in the mayhem, but the business hasn't been negatively affected to a great degree. I think that's due to durability of the business model. The company has built up massive scale on a network of integrated infrastructure that would be nigh impossible to now replicate from scratch, conferring them durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While Enbridge may face few truly formidable competitors because of their size, regulation and litigation are huge risks in their industry. The constant legal wrangling surrounding their Line 5 pipeline is an example of that. Their large size also works against them in some ways, as there's less growth potential with a mature business such as this. Even though the company is largely insulated from volatile commodity pricing, they are ultimately somewhat sensitive to this over the long run via volume, demand, and counterparty risk. There's a broader move away from traditional energy products. Enbridge has invested in renewable, but the core business model remains based on hydrocarbon consumption. Their balance sheet is solid and has been improving, but plenty of debt is on the balance sheet, and any increase in costs as it relates to raising equity or debt capital would harm the company's growth plans. Overall, Enbridge presents as a compelling long-term investment for those looking for a high yield. This is especially true with the stock down 20% year to date and now trading for an attractive valuation. The stock is available for a price to distributable cash flow ratio of 6.84 based on the guidance midpoint for fiscal year 2020 DCF per share. That's fairly analogous to a price to earnings ratio, showing just how cheap the stock is right now. Then there's the cash flow multiple. The price to cash flow ratio is 8.8 right now, which is disconnected from its 3-year average of 9.4. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate to account for the high yield and a long-term dividend growth rate of 3%. That dividend growth rate is markedly lower than what Enbridge has shown itself capable of delivering, both in terms of dividend growth and DCF share growth, and their minimal business impact throughout the pandemic has been impressive. However, with so much uncertainty around hydrocarbon demand both for the near term and long term, as well as Enbridge's large size naturally leading to less growth relative to the past, I think it makes sense to set ourselves up for low expectations moving forward. Enbridge could certainly do better than this, but I think it makes sense to be cautious. The dividend discount model analysis gives me a fair value of $51.09. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Enbridge as a 4-star stock with a fair value estimate of $43. CFRA rates Enbridge as a 4-star buy with a 12-month target price of $37. I ended up with a higher number, surprisingly. Averaging the three numbers out gives us a final valuation of $43.70, which would indicate the stock is possibly 37% undervalued. Here's the bottom line, guys. Enbridge Inc. is the largest energy infrastructure company in North America. Their huge scale would be almost impossible to replicate, and their incredible durability has shown throughout the pandemic. With a market-smashing yield near 8%, a double-digit dividend growth rate, more than 20 consecutive years of dividend raises, and the potential that shares are 37% undervalued, this stock offers a powerful mix of yield and value for dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alert. I'll see you next time.